Good afternoon. Thank you for coming. Let's start with a video. Why with a video? Our dean was supposed to give the opening speech, unfortunately had another commitment, very important commitment with the university. So he recorded the video for us, which I think is quite interesting. So let me play the video and then we start with the proceeding.
Good afternoon. I'm Michael Luger, Professor of Business and Economics here at Regent, and I serve as Dean and Pro-Vice Chancellor. I was meant to welcome you personally, but an event that I'm supposed to be at with the trustees was actually moved forward a little bit, and I had to leave early. So I thought at least this would represent what I would have said in person, so excuse that. Today's proceedings are very important, obviously. Important to society. The creation of wealth is important for individuals, but also for economies to make them prosperous. It goes back well before Adam Smith, 1776, The Wealth of Nations. And it's something important to Regents also because it's an area of scholarship and application that we're good at. It's a combination of two different fields, one of which is entrepreneurship and family businesses, where the creation of an application of wealth by family offices and individuals to create enterprises is important. And it's part of what we do in finance, investment, and trading, where we teach students how to go on platforms and to trade commodities and financial assets. The issues today, I've seen the program, are very, very interesting to me, and I would like to have been there. I want to thank Jacob for putting this together, my colleagues Gianfranco and Nikos for their participation, and for Chad and Jacob Papageorgiou and John Bernard Tanqueray for their participation as well. So again, thanks for coming, enjoy the day, and excuse my absence. Goodbye.
Dear students, fellow academics, esteemed guests, welcome to the third annual Wealth Management Forum. This year, we decided to focus on wealth tech and innovation in wealth management. As a senior finance lecturer, module leader of wealth management, investments and entrepreneurship, and as an investment professional, I take a natural interest in the subject. I believe that interdisciplinary approaches are very important, and this is also true for investments, tech and entrepreneurship. So what is wealth management? According to Baldwin van Papendrecht, a senior person at Ernst & Young, wealth management comprises services provided by an institution in order to manage the personal finances of clients in order to achieve the client's goals. And wealth management, in my opinion, is both an old and a new discipline. We're going to discuss it hopefully today. Private banks, brokers and advisors have been working with private clients for centuries. However, in the last 20 to 30 years, we've seen a big change in the wealth management industry due to regulatory and market changes. Nikos and Chad, our speakers, will expand on this in their presentations. Not just a few numbers about the wealth management industry to put things into perspective. Wealth management has seen exponential growth in the last few years. And among the largest wealth management firms are UBS, with $3 trillion in client assets, and JP Morgan, with $1.9 trillion. But smaller independent firms are also growing fast. Financial advisor, FT Advisor, reported a few days ago that St. James's Place, one of the leading medium-sized wealth management firms, has now assets under management of over 100 billion sterling, 100 billion sterling, which surpassed the mark for the first time. Let me show you a graph regarding the industry. This is the total industry in wealth management. The number for assets in 2016 on a global basis is $55.4 trillion in assets. As we said earlier, 3.9 trillion is UBS, so there's a market share of 7 or 8%. And JP Morgan is almost 2 trillion. It's 55 trillion. The growth that we expect in the next 5 years is going to be 14.2 trillion in assets, which will bring us close to 70 trillion. This is a massive industry. Now on wealth tech. What is wealth tech? Standard definition could be wealth tech is technology or software that helps investors make better investment decisions. A better definition, according to Suzanne Kishti, a woman who most recently published a book on wealth tech, which I think is very interesting and I would recommend, I use in my lectures myself. She calls wealth tech the impact that technology has on global investment decisions and the wealth management industry. So it's a much more holistic approach with regards to wealth tech. Let me give you a few aspects of what wealth tech could be. Digitalization in wealth management, why consumers are driving it and how established businesses can respond to it with innovative solutions. Digitalizing client advisory and robo-advisory. We're going to have somebody who's going to speak about robo-advisory. Digitizing wealth management operations, so on an operational level. Digital platforms, products and ecosystems. Blockchain application and asset and wealth management. We have somebody who's going to speak about blockchain. Wealth tech innovation is fueled also by entrepreneurship, so there's a close link between wealth management, wealth tech, and entrepreneurship. Developments in wealth tech. The Spanish bank BBVA report that many new companies have arrived on the scene offering advice based on artificial intelligence, so AI, and big data, micro-investment platforms, the trading solutions based on social networks. We're talking here about really a connectivity between different technologies and developments. Globally, there were 836 VC-backed fintech investments in 2016. 836. Within fintech, the research firm CB Insights continues to see growth in investments to companies focused on technology that supports investments in wealth management. This subcategory of wealth management within fintech hit a deals record of 74 financings across 657 million in 2016. I'll show you the graph here of the deals in wealth tech in the last few years, and you see a strong growth from 2012, 100 million to now 600, 700, 600 million. The top deal in 2016 was 100 million Series E investment to Betterment that included VC firms such as Menlo Ventures, Bessemer Venture Partners, Anthemis, City Ventures, and other VC firms. So out of the 650 million, 100 million went just to one firm, Betterment, which is now one of the largest firms in the US. Betterment is one of the largest robo-advisory firms in the market with approximately 208,000 customers. According to the latest ADV, there's an SEC reporting filed by the SEC. These are just numbers here on a quarterly basis, where you see how many deals in wealth tech. With the arrival of tech, more sophistication, wealth management is to change again. Patrick Donaldson of Thomson Reuters calls it the fourth era in wealth management, similar to the fourth industrial revolution. You know, the general aspect is that we are now in the fourth industrial revolution. And he thinks there's a rethink of the offering of wealth management services. Jacob and Jean-Bernard will focus on these aspects and hopefully the other speakers as well, with regards to crypto, blockchain, and robo-advisors. So what are the opportunities and the threats? Is it too early, very early for these new technologies, or not? Surprise, surprise. I'm an academic and a researcher, Hence, I believe that knowledge is key. We need to study, understand, and critically analyze before we jump to conclusions of what is going to be the aspect of wealthtech. But we also need to have an open eye and open ears. So now to the proceedings. We start with 4 presentations. First, a presentation about crypto by Jacob Papageorgiou, followed by a presentation by Tanqueray about his startup, Finlight, very interested to hear, followed by a presentation by my fellow lecturer, Nikos Nitsas, on CFA aspects, ethics, business ethics in the wealth management industry, and last but not least, my colleague Atwal, who is going to speak about the traditional aspects and the traditional, from a financial planning point of view, representing the more traditional industry. We're going to have a break then from 5:30, 5:45 to 6 o'clock. So we can again use the time to network through the press meeting. And then we're going to have a panel discussion with all 4 speakers, moderated by myself, and closing remarks by my colleague, Professor Gianfranco Vento, who's just came in. Thank you very much. Welcome, Gianfranco. And I wish you a great conference. And pass on to the first speaker. So the first speaker is Jacob Papageorgiou. If I may just read quickly his CV. Jacob is an avid blockchain enthusiast and trader who holds an MSc in Management and Innovation from UCL. He was previously a project manager at Hiscox Group, where he helped implement solutions for clients such as Barclays and Amazon Business. He's also a strategic marketing advisor to cryptocurrency project Cheerio, a charitable blockchain solution whose community consists of over 20,000 members. Jacob is going to talk about blockchain. And here is his presentation. Jacob, the floor is yours.
Hi everyone, hope everyone's okay today. So before we get started, yes, nice intro. So before we get started, because normally, in wealth management, everything is about commodities, equities, traditional ways of coming to grips with things. If anybody's heard of crypto, it was literally where the pirates were lurking in the dark web ages with no access to anything. Back in the day, you couldn't buy a crypto as easily as you could trade a robo-advisor or an ETF or all these things. So kind of the more tech-savvy geeks had access to it and were able to maneuver over the wallets. So I'm not sure who's familiar of this new asset class. So can I get a show of hands of who's heard of Bitcoin? Okay, so we know what we're talking about. So the question is, right, we're in wealth management, and the most common thing I hear is, do you take risks? And what does risk essentially mean to someone that comes from a wealth management background versus someone, as you can see on the bottom right of the screen, that's associated to crypto, right? So if you look at the history of money, we used to trade kind of barter, and then we shifted to gold and silver, and then eventually we had the first bit of paper money. And then people became accustomed to kind of having paper money pegged to gold, and that took about 100 years, and some crazy guy discovered the credit card just when we started becoming accustomed to the pound and the dollar, and he said, hey, now you've got to get accustomed to this plastic thing that you can use. And little did we know, we had a kind of internet era burst out of nowhere, and now we're using mobile phones, we're using digital currencies and all sorts of new emerging digital classes. So I'm here today to kind of answer the question to myself as well as you, to draw stats to prove whether crypto is a new and emerging asset class, and whether traditional wealth management aspects of it can be used for diversification. So, a BBC filmmaker, Adam Curtis, said the truth was their revolution was not about an idea, but it was basically about how you manage things, right? So, the same way that we have equities, commodities, Facebook, Snapchat, Instagram, shares, we also have crypto assets. So, the cryptocurrency market is divided into things such as tokens. We've had initial coin offerings. We've had settlement networks, smart contracts, the ability to kind of make machines transfer value without an intermediary. You've had utility, now most recently securities, and that's all divided by proof of work and proof of stake. So this is kind of an overview of the market that we live in. And if we're going to size the market and kind of see if it's relative to what's already existing, we've kind of got a little preview from Professor Jacob earlier. You can see that the whole crypto market as a whole, well, that says 450, but it's now a little bit less due to the bear market, is a fraction of Google, or Bitcoin is kind of close to the Bank of China. So it is a new and emerging asset class, but it's got a very long way to go. However, the behavioral trends are all the same. Now, if you look at the crypto economics, you've got gold that we mentioned, you've got the FTSE, you've got the S&P 500, and if you were to put $10,000 in 2014, you see the way that these asset classes behave. And I'm not here to put a smile on your face and say, oh my God, we need to check out Bitcoin, but actually the way it's behaving like that because it's a new technology. It's going on the S-curve, if we've heard it, in terms of adoption. There's been an interest, and because of the volatility of it, it kind of behaves the way it does. Now, if you look at the market cap, just like an indices, just like the AIM market or any other market, the crypto economics are the same. So Bitcoin was the first to come to surface, therefore the volume and the market cap is larger than the rest. But then you've got Ethereum, you've got Ripple, that's quite common, the most recent fork, Bitcoin Cash and Litecoin, all in like 246 billion volume. And then the best thing that I've picked up when I talk to people is that markets behave based on news, based on sentiment. There's a lot of fundamental analysis that comes to play, whether you're a technical trader or a fundamental analyst. And as we may know, who's seen Elon Musk's most recent tweets that kind of got everyone, the Tesla shares started tanking, or his most recent podcast with Joe Rogan, right? So that's basically media influencing the price of an asset class. And if we look at our friend Jamie Dimon, the CEO of JP Morgan, he's managed to influence the crypto markets in a very negative way. So the retweets, the social media phenomenon is shared much more when it's negative news. Whereas on the positive side, when it's kind of good news, it's still good, but it doesn't affect people in the way they trade. But we use the fundamentals and the technical side of things to gauge markets, like are you a short-term trader or a long-term trader, what kind of tactics do you have? So if you guys are familiar with that, it's very, very similar. So most recently, off the boom of the 2017 in December, there's been a very big interest from hedge funds, traders, institutional investors, and retail customers, but it's slowly creeping up. It's been at its infancy, but we believe that kind of social media was the big influence, and now that the market is maturing, everyone's going, okay, we understand, we're digging into technicals, we're digging into fundamentals. So there was 84 crypto funds launched in 2017, and we anticipate more than 150 launches in 2018. So the big question is it an asset class that you can diversify into? Are people looking to experiment, diversify, or are they simply curious about cryptocurrency? Now, has anybody traded in this room in regards to crypto? Okay, show of hands. Okay, a few of you. Has anybody traded Forex? Familiar, heard of it? Yeah. So what kind of traders are out there to hunt you down? There's short-term traders that have strategies. There's long-term traders that choose to diversify various other ways. And if I put it into perspective, basically short-term trading is made up of taking advantages of short-term price swings, and that involves buying and selling crypto over a span of a day or a few hours. So your strategy, if you're diversifying, would be much more different than the long-term traders that buy and hold, and they speculate, and they look at the price trends over long periods of time. Now, when you look at robo-advisory services, you look at asset managers, and you look at trading crypto, there's certain advantages and disadvantages in all the markets. So some of the advantages that cryptocurrency has, due to the technology and the underlying fundamentals, is the cheap fees and the fast exchange. So exchanges, whether they're decentralized or centralized, that's kind of a different topic that we can touch on, that you can see me after, has a lot to do with how the fee structures of exchanges are done. So if you're looking in wealth management, you can charge an asset manager, whereas if you use a decentralized exchange, the transaction is conducted by the Ethereum smart contract. So you kind of say bye to the intermediary, and you are your own bank. So if I feel like trading £500, I can do it with no fee. If I trade £5,000, the same thing, because the trade is executed by the smart contract. Now, I've put volatility here as an advantage, but for anyone that hasn't done their homework, that term that was on that bottom corner before, the term wrecked in crypto, which means to get completely destroyed because you have no idea what you're doing, is because of the extreme volatility. So, as Professor Jacob mentioned, the whole industry is $1 trillion industry. However, Bitcoin is only a fraction of that. So, if it's only a fraction, it only takes a little bit of funding to cause a pump or a dump, or make the price go up and down. And I'm sure everyone's heard of these kind of terms in the crypto sphere. So, if you know what you're doing, you can leverage, you can use all sorts of techniques in trading to expose yourself to the volatility. However, if you don't, it's a big risk. And the other key benefit is that crypto markets are open 24/7. So rather than, it's 5 o'clock, you want to go out and trade, you can on a Friday. You're not limited to kind of the traditional markets. So if you see this, it's basically something you guys I'm sure are familiar with, because the same way you could trade commodities or trade shares, and I've deliberately not labeled the percentages there because it's up to you to interpret what that means. You can also kind of invest in startups, so i.e. Monzo or Acorns, or use robo-advisory services that have their own return, their own ROI, and now most recently you could trade crypto and build baskets of crypto. We've heard of the up and rising ETFs or the ETN interest, so the traditional institutions are gaining interest to try and diversify into this up and coming asset class. So whether you choose to pick either basket, it is a form of diversification. And of course, diversification depends on risk appetite. So just like any other market, risk appetite is, in terms of diversification, consists of low, medium, and high risk appetite. So if you've got low risk appetite, the same fundamentals apply, the same theory applies, where you can go, I want to hold for a prolonged period of time, therefore I would choose a low risk appetite portfolio, which is something that has a larger market cap and is less volatile than something that's in a lower market cap. So for instance, the first one has majority Bitcoin and a little bit of Ethereum and Litecoin, whereas on the other side, high risk constitutes of more alternative crypto assets, is what they're called, so anything that's not Bitcoin. because of the low market cap, it's subject to more volatility. Now, have we heard of dollar cost averaging? Okay, I'll get there in a second. But because in crypto we love cartoons, we love kind of going on the funny side of things, we've talked about the piracy of it meeting the traditional money. In crypto, there's a lot of animals lurking on crypto Twitter, right? You get dogs, you get cats that do some crazy technical analysis, but you're looking at a picture of a turtle or a grasshopper or whatever it is, and you're going, is this real? Like, are we just at the beginning of something? Why has this space come to be the way it is? But essentially in crypto, if you look at the turtle, it's a metaphor for dollar cost averaging. So putting in money without looking at the price because you're a long-term investor, and putting the same amount of money for a prolonged period of time in order to reap a higher or lower return on investment. However, based on that risk and based on the asset class that you choose, you'll be exposed to different merits of diversity. So what I've done is I wanted to kind of bring my personal background because before that I was a musician for 11 years. I had no idea how to trade and I had to learn the hard way. So I've lost a lot of money to make money, but I said if I were to share something, it would be a personal screenshot of an Excel spreadsheet. So what did I do when I got introduced into crypto? I kind of went, okay, I'll use Excel, I'll plug in a bunch of numbers, but I'm comfortable as a student to put in $100 into Litecoin, which is similar to Bitcoin, every Friday for 8 months without fail and see what happens. Now, by all means, if you were to do it today, it would have changed, but I wanted to keep the same spreadsheet because I kind of stopped after that because I was really happy. But essentially, dollar cost averaging is composed of here putting $100 into the same asset by doing your fundamental analysis. So you believe in it, you kind of look at the team structure, you look at the roadmap, you look at everything that the thing is composed of, the technological protocols, any upcoming updates. So it's big on fundamentals. But you can see here that without fail, even though those numbers can vary today, it is an element of diversification, right? But diversification without an asset manager, without a robo-advisory firm, even though they've crept up now, but back then, you had to do it on your own. And then the other one is the Grasshopper, which is essentially pairing trades and being more of a short-term trader. So what happens is you put £500 into a crypto asset, in this case called VeChain, and if it goes up, you take the 500 initial investment or your profit, whatever it is you choose, and you put it into another asset class that's not necessarily doing badly, but doing okay, or that you believe in it, kind of shuffle around. So it's this shuffling methodology. And then when that goes up, kind of shift around. So you've only put in £500 and you're diversifying risk using this other method. And I swear to God, it will drive you insane. Because you have to do it constantly and kind of shift around. But also, this is also a method of diversification. So when you track the hoppers, it's the same as the previous example where you're diversifying risk in a shorter time frame. Now, as I mentioned the pirates before, for the pirates to succeed, you need to follow certain rules. So we need regulation, we need speed, we need trust and availability, we need reputation. So from 2009 to 2018, we've come a very long way in terms of diversification and technology and regulation. So what's hindering this asset class is regulation and technology and ease of use. So at the London Block Exchange, we said, can we use the fundamentals of design to ease the onboarding process, to ease the understanding, to bring in the education, to make your average Joe realize that this is an asset class that is very similar to what you're used to. And to do that, we've had to teach the regulators, we've had to talk to the FCA, talk to the APPG, and follow the same route, so introduce custodial services. All these things are kind of helping mass adoption happen. So here's our little app, and as I mentioned, design and diversification. I want to ask you a question to see if you've been paying attention. So if you look on the left side here, can you tell me what kind of risk profile a person with these asset classes would be classified into? Is he a low, medium, or high risk investor?
I'd say extremely high. Because it's just one asset class, isn't it?
There's Bitcoin, there's GDP, there's Ethereum, Litecoin, and Regent.
Medium then. If there's pounds in there as well, you can see that it's high risk, but probably less risk than micro.
Yeah, that's correct. So I hope you've learned something today in terms of crypto as an asset class and the similarities and differences. As I said, we're living a shift in paradigm. So you look at Eric Schmidt from Google, he said it's a remarkable cryptographic achievement. The ability to create something which is not duplicable in the digital world has enormous value. Lots of people will build businesses on top of that. So Bitcoin as a store of value versus anything else is a whole different topic, but anybody that's interested and wants some slides, I'm more than happy to share anything you want or answer questions at the end. So let me ask you again, is crypto a real diversifier? Thank you very much.
Thank you, Jacob. Very interesting. I think we're going to have lots of questions for you later on. So keep the questions for you. Now I'd like to call on Jean-Bernard Tanqueray, who is going to speak about his venture. Let me just read you his biography. My association to Jean-Bernard goes back probably 10 or 15 years, the times of the hedge fund industry, and I also see that you work for Citibank, so we have a lot of commonalities, apart from being francophone. He has managed family offices for more than 10 years. Prior to that, he was an institutional fund of hedge funds manager at Fortis Investments from 2003 to 2007. A fund rating associated Fitch from 2000 to 2002, and a fixed income derivatives risk manager at Citibank 1997 to 2000. He graduated with an MA in finance from ESCA, Université Catholique de l'Ouest, Angers-France, followed by an MPhil in international finance and macroeconomics from Paris Dauphine University, and an MBA from London Business School. Pass on to Jean-Bernard for his talk. I'm good at PDF. I apologize. Okay.
So I'm on PDF, this is voice. Let me see if I can maximize. 10%, is that a bit better? No. Okay, so I'm Jean-Bernard Tanqueray. I'm the founder of Finlight. So to give you a bit of my background, I first, just getting a bit lost with this. 1 sec. So I'm just doing something. Anyway, it's okay. So I started the company as Studio Banker because it was a financial navigation system with the view that you don't need anyone to tell you what to invest. Technology is not here to reinvent the same old wheel that robo-advisors do by replicating the same third-party discretionary fund management. Actually, technology is here to empower people and to give me the tools to do things by myself without relying on third-party intermediaries. So that was the hypothesis of Studio Banker, very nicely named. And it was really much more like a financial navigator that would give people who are too rich not to care but too poor to get a proper service to retain control and decide by themselves. The only problem with that, it was a sort of major shift forward, leap forward, and people face the same hurdle all the time. I mean, when you go back home, you've got your wife, your kids, we want to go back into the financial reviews, tax reviews, and things like that. So time in the hotel, and you took quite a lot of time to educate people. And because we were small, nobody among the traditional data provider or asset managers wanted to give us any data. So what do you do when you're small? You only have yourself to help. So we created a lot of web scrappers and ways to get data about every possible investment my initial target, the first student, were interested in. And at that time, my family office colleague came to me and told me, you know what, I know what you're doing. I hate spending time getting the right information to make the right decision. Can you help us? And this, like that, in April 2017, with the help of Natasha in the room, that we grew into Finlight. So, and we back in schedule. So just for 1 second, I'm trying to redo that so that you see the whole thread. And now we're Finlight. And Finlight, what it is, it's a virtual investment analyst. And what I'm going to tell you about my startup is more about how artificial intelligence is here, not to replace me, but to augment my capacity of making decisions, how I can step forward in my ability to make decisions. So our vision initially, as a software as a service solution using AI, is to address family offices, high net worth individual, critical challenges. Quick question, who's familiar with a family office? Who knows what a family office is? Okay, so basically when you're very rich, you hire your own team to manage your own money. So basically that's a family office. And those family offices face critical issues of integrity, information asymmetry, and market opacity. So I use this very academic term here at the university, but basically, even though you're very rich and can afford to have your own team, you still sit at the very end of the information chain. Before you know something, lots of people know it before you. And that affects that other critical challenges, because when you're rich, you want to stay rich. It's called capital preservation. Is how you assess risk, aggregate the right data to risk adequately assessed, and therefore how you manage that risk. And to respond to these challenges, what we do is to actually support them, even supplement them in their strategic decision making by using the power of artificial intelligence to support due diligence. So when you invest, just to make sure you're picking peach and not lemon across all investment type, whether it's a cryptocurrency or a commodity or whatever. And therefore from there, go predictive analytics to alert you before a change occurs in your portfolio. Typically, just a quick example, when you use a third-party fund manager, call it BlackRock, you buy whoever else, you buy into a guy to manage your money for you. But then this guy might actually leave his job, and you know it when it's too late, and or he's going to go fundraising, meaning getting more assets into his product, and then he no longer sits at his own desk, so who's going to run that money for you? And it's kind of risks, execution risks, other family officer, other high net worth individual, I want to be made aware of, and that's what we call this alert. And thirdly, because you managed to bring a whole pool of savvy investors, is how do you democratize that knowledge with a wider population? And how you help actually family office further the impact. To understand it a bit more in perspective, what you need to understand is family offices are at control, but control is costly because you hire experts like Jacob, like me, like whoever, on high salary and ambitions to manage people with very complex requirements because you want to move away from banks, because you no longer trust banks, because banks put some of your money with Madoff, or with some products that got completely illiquid the day you needed the money, typically during the financial crisis. And therefore, you want to increase that control not to be trapped again. But this decision-making process is quite penalized, impaired by three things. Limited IT support. It's a nimble shop of experts. None of them came from an MIT education about IT and computer sciences. So basically, you use very clever people with very unclever tools. Data is fragmented. Data is everywhere. We're in a digital age, lots of information overload, but when you try for, let's say, one M, if you type BlackRock equity investments fund, whatever, on Google, you'll have 1 million hits. So what kind of information source is going to be the right one to look into for your own due diligence, whether you make, whether this fund is the right one for you. And third problem, the inadequacy of current providers. Family offices reach people when they want to manage their money, they want input to the decision making, but today the wealth management sector is structured in such a way that they've pushed product into you. They want to remove your input and force their own output onto you. And this creates, all this together, a high risk, high decision-making costs. And this problem remains unsolved because of a fragmented source of data providers, and there's no central aggregation that give you access to qualified information and opportunities. It's just like if you want to get data on the financial market, if you want to have fewer managers, if you want to go to research, we've got plenty of tools. And the one today most family offices prefer is this one, and really need to know it well. Word of experience. And you understand this is a problem we're trying to sell by being an investment data aggregator with an artificial intelligence overlay. And what artificial intelligence actually does, it enables us to provide users with a virtual analyst interaction, collect scatter data and make sure that you're not blending peers and apples, and turn that disparate data where everybody uses different nomenclatura, different classification systems into harmonized decision factors. There again, make sure you compare peers with peers. And as we said, managerial alerts, because we know that when you need to update your LinkedIn profile, you'll probably be on the move on the job or things like that. Or the news flow. When if you look at FTFM, you get reference on a few occasions on professional papers, you become a celebrity of some sort, and therefore you become a desirable product for competitors. So we bring all these sources of information, data about investment managers, data about markets, experts, independent experts, combined with investment requirements and the investment reporting requirements into a comprehensive investment decision application to cover the whole span of decision making for these guys, meaning investment planning, what is my risk budget, what is my risk allocation, what kind of manager should I go for, due diligence with the bot summarizing all data about people and facilitate due diligence by helping you identify, flag areas of concerns or not, and finally risk management with engine alerts, capital protection, all the things together. Our USP there, what we're trying to deliver basically is to enable family offices to minimize downside risk, operational risks, and run lean. So basically, put simply, is for the family office principle for the government of the money to increase the rate of return on his family office team, and for the family officer to increase the rate of useful time. So we bring productivity, we enable collaboration among stakeholders, protection with capital insurance solutions, network of experts to supplement your knowledge, and independence. We don't depend on anyone. We are funded today by our own clients. Typical target leader. That's one thing from a wealth innovation point of view, based on this forum, it makes more sense, is investors want to access information differently. I think we all agree on that. And the person we're going for is what Deloitte call the rewired investors. It's very ego-driven. Here we go. Stay in control, very DIY mentality, DIY ethics. It's going to be digital, personal, easy, and they are skeptical. And I think it's a big new thing here. Before people would buy, we look at financial experts as experts, not as deity, but still someone with something better than I do. And our people are naturally skeptical. Skeptical of authority, skeptical of what they show, what they want us to contradict things in a very easy way. And we've got a completely different attitude and risk. Volatility means nonsense to them. It's about how much can I lose and how do I diversify across all other classes, including cryptos, in a way that minimizes my downside risk, which is my maximum loss aversion. Okay? And they're not stupid. And within that typical change of mentality of investors, us personally, we go after the mid-sized family offices, so still quite substantial, 250 to 500 million sort of wealth. We know they've got to make better decisions, but don't know how to, because they've got, whether you want it, you like it or not, budget limitations, you kind of hire a whole team, staff shortages, and they want to remain nimble. So this sort of summary of what are investment providers, investment data, of solution providers. You've got the traditional investment consultants who sort of are going after, they bring expertise, but they're very not efficient to use, and you're not sure whether they're transparent and enable you to actually control your portfolio. You've got financial navigators like SLRs. Yes, built by experienced people, but it's not easy to implement. Yes, it gives you control, but you've got little ability to know the data is actually transparent because they use third-party data that is from the investment provider itself, and therefore the investment provider to want to report ideas in a way that, from a marketing or commercial point of view, doesn't make me look that good. Then we've got traditional discretionary managers, and again, I do not make any distinction ever whatsoever between a traditional private bank and a robo-advisors. Because there again, I need to choose someone else to decide for me in a way I don't necessarily understand. You may have the financial experience, but you don't have a plug-and-play efficiency. It doesn't give you any control, and you have no view on information transparency. And you will understand that from the perspective, information transparency is really important, because I want to make sure I know everything. And like before, I wasn't necessarily told I should know because it was really good for me to know. That's, Moderator and information asymmetry issues. And unlike providers, we've got lots of IT providers want to give you tools to decide, but then you don't really have any view on their financial expertise. And Fin platform, they give you control, but again, it's an understanding of to discriminate good from bad data, and then not necessarily supplementing your knowledge, supplementing your skills in a way that suits your digital lifestyle. So basically, we started the company in late 2015, researching customer discovery, the fourth year, the different wealth segment. By mid-2016, we had 100 users. We became fully operational by Q3 2017, where we onboarded 10,000 funds using a little watch scrapper and things like that to get overall information, ratings, prospectuses, anything you can know. We joined an accelerator, the Family Luger, which is indirectly funded by the Family Office of Bernard Arnault, and we've now been recommended by the Family Office Eco Foundation, which is a Swiss-based association of single-family offices managing at least $500 million. And now we're ready to move in full beta. Which is a bit of chaotic flavor here. Our goal is to be the family office investment reference. This year we're completing the rollout of our artificial intelligence tool, getting our bots to learn more and better, especially a due diligence bot called Alfred. So in a couple of weeks' time, it could be, you can go to our Finlight.com website and say, tell me, Alfred, how good this manager is, or tell me, Alfred, what the people say about this gentleman, or can you summarize his legal documents? And in less than 24 hours, Alfred will be able to give you a report. And monitor the reputation of all those people. Next year, we open to independent experts because we don't believe that artificial intelligence is here to replace people. It's here to increase knowledge and learning. It just helps us make walk the next step and to become the absolute referee, and then try to make strategic partnerships with major data providers like Luger. So that's who we are. I'm very blessed to be surrounded by a great team. Eve used to be the CIO of Lehman Brothers Asset Management, so when we're talking about information asymmetry, we know what we're talking about, and register to our website because it's going to publish an article about his experience there. Carissa, which is a US fintech, she's an expert, she's based in New York. She does our sales there. Ian, based in the UK, on sales, and we've got Feedback based in Toronto, doing our back end. And we're having a new person joining, a new partner joining the team, which is Lucy Walker, experienced in digital experts in the UK. And we've got top-notch supporters here. We've got Uwe Boyosenga, who used to be involved with SAP and the head of the Global Network Family Offices. Usama from the Family, which is sort of new accelerator/VC, and partnership with the head of cybersecurity and AI at Microsoft, and also another business school in the Netherlands created to get support, create trust, and send you on. Basically, this is us, Finlight, the virtual analyst for family offices. Thank you very much for your attention.
he is a fellow lecturer at Regent University London. Nikos has been employed as a lecturer in finance at Regent University since 2009. His research interests lie primarily in the areas of investment strategy and market efficiency. He's taught a variety of finance modules to both undergraduate and postgraduate students at Regent's Business School, European Business School at Regent's American College, London. Qualifications, MSCI in Economics and Econometrics, Exeter University, Exeter 2003, BSc in Economics, Athens University of Economics and Business, Athens, Greece 2002, and of course CFA 2018, the first CFA on the faculty. So on to Nikos.
Thank you, Jacob. So, hi, everyone. So, Jacob asked me to do a talk on professionalism and ethics in wealth management, focusing on wealth tech, basically. Okay? And this is what I've tried to do. In the first half, let's say, I'll talk about the professional ethos, let's say, and the value of professionalism within wealth management, and then it gets slightly more interesting, because I will talk about a specific, let's call it, ethically dubious decision made recently by one of those new startup wealth tech companies, and how we link it with what we talked earlier about professionalism, ethos, and so on and so forth. So, if you're bored in the first half, bear with me, it gets more interesting. Okay? So, the issue obviously is trust. Okay? We're all familiar with the fact that trust in experts has evaporated. Okay, we've seen it with Brexit, we've seen it with the election of Donald Trump, obviously. Okay, and as you would expect, financial services don't rank very well. Okay, here we have data from Atwal, which is a global communications consultancy, and every year they do this trust barometer. Okay, there have been drops in trust throughout. Okay, in all sorts of experts, and as I said, finance doesn't look very well. Okay, so it's the light grey line there at the bottom. Okay, it's the least trusted sector amongst all those you see there, including technology, healthcare, energy, and so on and so forth. So, you know, technology is still very much trusted. This is across the globe, by the way. Okay, finance is doing slightly better, which is to be expected as people tend to not remember the crisis that much. Okay, but still, you know, we see it's lagging way behind. Okay, so there is an issue of trust in the providers of those financial services. Okay, so we need to see how we can establish this trust. Okay, and since the whole session is there about wealth management, how we can establish trust in wealth managers and investment managers, right? So one way, okay, this trust can be established is to view the whole wealth management practitioner as a professional. Okay, just like a doctor is a professional, right? An accountant is a professional, an actuary is a professional. We want to see a wealth manager as a professional, okay? In the sense that they practice behavior which is client-focused, right? They have high entry standards. There's a body of expert knowledge they have to follow, okay? They encourage continuing education. They're overseeing bodies. Sometimes you have to belong to that body in order to call yourself, right, a wealth manager, an investment manager, and so on and so forth. Okay? So, as I said, they have been, you know, after medicine, law, perhaps religion, the next established profession, and actually in this country in the 19th century, probably started from Scotland, was auditor or accountant, right? And then, you know, the set of profession expanded. You now have, you know, actuaries, you have chartered engineers, and so on and so forth. Okay, so we would like to see wealth management and investment management kind of, you know, occupying that space as well. Okay, being seen to be a profession. okay, just like an auditor or a lawyer. Okay? So, is wealth management a profession is our next question, and the answer is maybe, okay, or rather it's trying to be. Okay? It's still relatively young as a profession, recognition lags established professions, okay? So it's challenging to create trust, okay? Nevertheless, we have seen the emergence of bodies, either nationally or internationally, that try to cultivate this professional ethos, let's say. Okay? So amongst others, in this country we have the Chartered Institute for Securities and Investment, which was endorsed by a Royal Charter 10 years ago, roughly. Okay? In the US, we have the CFA Institute that has also emerged as a kind of international investment management professional body. Okay? So we expect from these bodies to help establish the ethos, let's say, of the investment managers, of wealth managers, right? To communicate to the public the code by which those professionals should operate, to help in continuing education of those professionals, and so on and so forth. Okay, so that's kind of the ideal. We talk about honesty, integrity, the reputation, be accountable, be reliable, continuous professional development, which is very important. Obviously, avoiding conflicts of interest, be objective, transparent, and so on and so forth. Okay, so within that context, as I said, the CFA Institute has emerged as a kind of an international body for investment professionals, investment managers, wealth managers, and so on and so forth. So it has also published what they call the Asset Manager Code. Okay? So the idea here is that it's a voluntary code of conduct that helps asset managers practice ethical principles that put clients first, ideally, right? So we need to see managers acting in professional and ethical manners at all times for the benefit of clients, independently, with objectivity, skill, competence, diligence, communicating with clients, and upholding the rules that govern capital markets. So this is the ideal. Okay. Interestingly enough, this asset manager code has been adopted by hundreds of investment management companies, including the largest ones like BlackRock. There's a nice list which you can find on the CFA Institute website. Okay. So this is where we are, okay? Trying to build trust in an industry where trust is lagging behind other sectors. Okay? We try to do that by building a professional ethos. Okay? And those national or international organizations try to do it. One way to do it is by this asset manager code, which stipulates certain responsibilities from the point of view of asset and investment managers towards their clients. Okay? So, how does all that apply to robo-advisors? Okay, it's the more interesting content of my talk, I know. So, if you're not familiar with robo-advisors, they provide investment solutions through online platforms, usually via an app. Okay? They reduce the need for a direct interaction with financial advisors. Okay? So most of them follow a passive investment approach. They have low fees, which is a very, very big selling point. Right? Low account minimums. Okay? And they implement the strategy again via low-cost vehicles like diversified index mutual funds, or more often exchange-traded funds, or ETFs. Okay? So the idea is that those robo-advisors reach underserved populations, mass market segments, mainly millennials, okay? 20s, 30s, they usually don't have much savings, they spend most on rent, right? And avocado, let's say. Okay? So those people, those segments of the market would not be able to afford a traditional financial advisor. Okay? So we kind of democratize, let's say, financial advice. Okay? You can have fully automated digital wealth managers or advisor assisted, where you also have the option to consult an actual person. Okay? So, as you would imagine, those investment or robo-advisors have drawn the attention of regulatory authorities, and they are indeed regulated. We're going to speak more about regulation a bit later. Okay? In the US, by the SEC, in the UK, by the Financial Conduct Authority. So let me speak about Wealthfront. Okay? Amongst the startups that emerged around 2010, Betterment and Wealthfront are the two largest. Okay? It was first founded in 2008, or rather it was founded in 2008, and by 2013 it had 97 million in assets under management. Okay? The growth, the initial growth in the next 2 years was very high. Okay? So as of June 2018, they had more than 10.3 billion in assets under management. Okay? If you're familiar with efficient market theory, you will probably know this book, Around Walk Down Wall Street, published in the 70s. Okay? It was probably the first book that popularized this academic theory that you can outsmart the market, basically. Okay? The author was Burton Malkiel. He's now in his 80s, but he is the chief investment officer of the company. Okay? They have received more than 200 million in venture capital funding, and the potential there is huge. Right? So, if investable assets in the US are around 33 trillion, we saw the presentation earlier of Jacob that globally they're around 60 billion. Okay? Around half of that are in US assets, so capturing just 1% of that market and assuming an annual fee of 0.25%, okay, this means that the income would be more than 800 million per year for the company. Okay, so there's big potential there for growth. Okay, and as you would imagine, traditional investment companies wouldn't, let those firms without competing with them in the same arena of robotic advice. And this is what happened, right? By 2015, robo-advisor services were offered from traditional firms. Okay, the two main ones, the two biggest ones, as we're going to see in the next slide, is Schwab's Intelligent Portfolios and Vanguard's Personal Advisor Services. Okay, so they also have a very low cost. Okay, and once those guys entered the market, the growth of the startups, right, either stalled or even dropped. Okay, so they're now facing problems. There's an increasing competition. They have to spend more in marketing to acquire new clients. The clients they have small account sizes. They can't seem to be able to grow the average account size because the wealthier customers go with the robo-advisor of the traditional companies, right? So they have to do something. Here is the assets under management of selected robo-advisors as of June 2018. You see Vanguard, Schwab. Remember, they only launched those platforms 3 years ago, but they are dominating the market, okay, because they already have access to the client base. Okay, so Betterment and Wealthfront, which more or less started offering this service in 2010, are the two largest companies that have emerged as disruptors. Okay, but you see how Vanguard is dominating. Okay, so when you're faced with such a scenario, what do? Okay, or rather, what is the ethical thing to do? Let's see what Wealthfront decided to do, and then we'll discuss whether what they did was according to the standards we want investment managers and wealth managers to behave. So what they did is they decided to abandon the principles. Okay, as we say here, the passive investing activities. Okay, remember, those are guys that are marketing themselves as, we only invest in very low cost vehicles, simple to understand investments, simple to understand asset allocation. We even have on board the guy that made efficient markets popular, right? But using that strategy, we're not making money, or we're not making as much money as we should, given that we also have 200 million in VC backing. Okay? So what do? We sell expensive products. Okay? We sell expensive, difficult to understand, opaque products. Okay? And this is the decision they made. As I said here, for the last 8 months, okay, Wealthfront decided to invest 20% of its investors' funds into an internal risk parity fund, okay, which in turn is invested in complex derivatives known as total return swaps. Higher fees for this new strategy, on top of the costs associated with buying those swaps, because you pay interest rates on those swaps, basically. Okay? So once you're faced with increased competition, what do? You abandon your LTOs, or at least that's what Wealthfront seem to do. Okay? You move from passive to active, and from cheap to expensive. Okay? And from simple to opaque, to financial engineering. Okay? So they follow a strategy called risk parity investing. Okay? This is a strategy employed by mainly, hedge funds, more or less. Okay? I'm not sure it's suitable to small investors. Okay? It's difficult to implement. It's costly, right? And it needs, the use of, as I said, swaps to increase the leverage of the portfolio. Okay? So very simply, the risk parity kind of investing assumes that each asset class, or stipulates that each asset class will have the same risk contributions to the overall portfolio. Right? In the traditional balanced, let's say 60-40 fund, the risk is dominated by equity. Okay? So what these guys are saying is that the risk should be equal for each asset class. Okay? Bonds, equity, real estate, commodities, and so on and so forth. Okay? So they look at the data, they forecast the future volatility using probably arcs and guards type models. Okay? They forecast the covariance of the assets. Okay? And what they're trying to do is to create a portfolio where the risk contribution of each asset is the same. In practice, what happens is that they have portfolios with much, much smaller allocations in equity. Okay? The allocations are dominated by bonds. Okay? There's some allocations in energy stocks for these guys, and also inflation index bonds. Okay? But the allocation is kind of dominated by bonds. Okay? So overall, the allocation is much less risky than a traditional 60-40 allocation. Right? Less risky allocation, less return. So how do they generate the return? They have to leverage the portfolio. Right? They have to add debt to the portfolio. Either they borrow, because they can't really borrow, right? Or they go down the financial engineering route, as I say here, employ total return swaps. Okay? So for each segment in the portfolio, they come to agreement with the bank, they pay a spread on LIBOR, and they receive the return of the portfolio if the portfolio values go up. Okay? If the portfolio values go down, they pay something to the bank on top of LIBOR plus spread. So you see how quickly we went from a simple, traditional asset allocation into something very opaque, very difficult to explain, to be honest, to the average investor, that needs the use of swaps, okay, and so on. So and the worst thing they did is that they implemented that on an opt-out basis rather than an opt-in basis. So automatically, all the large accounts they have, 20% was invested into this risk parity fund, this expensive, costly, difficult to explain, opaque way of investing, right? So you had investors who signed up for passive management, and they suddenly found themselves in an active strategy. They could still opt out, but they were automatically opt-in. Okay, and I would say that this is quite problematic. No, the client could opt out. I don't know whether it's going on, I'm not a regulator. Okay, the client could still opt out, so you go to the settings and you say, I opt out. I don't know what the clients have signed initially and how much leeway the company had. But this is what happened. So this is how to try to convince the client that things would be great. Okay, they backtest the data. Always be aware when you see backtest data. Okay, they backtested the strategy against initially a diversified portfolio. Wow. Similar volatility, much higher return, right? Sharp ratios, very high. Great. And then they also backtested the strategy against the competitors, right? These are the quant guys, the hedge funds, that initially came up with the idea, right? So these are the really strong quant guys with PhD in physics and so on and so forth. Okay, they said, listen, if we backtest our strategy, we can do even better than those guys. Okay? I'm talking here about the Bridgewater All-Weather Fund and the AQR risk balance. Okay? So they're saying that their strategy, either from 1996 to 2017 or for the last 5 years, has a much better risk-return trade-off than those clever guys with the PhDs that first came up with it, right? So, for example, AQR, which is a very famous office, also published academic papers and so on. Okay, they had a 0.32 Sharpe ratio for the past 5 years. They said, okay, we could have had 0.66 if we followed our ways of doing things. Okay, so this is how they marketed the fund to investors, right? Better Sharpe ratios, better risk-return trade-offs. We can do better than those clever guys that came up with the whole thing. As you would imagine, okay, good backtesting results, probably bad realized results, right? So let's look at how the fund actually did. Okay, this is a comparison with AQR, risk parity fund. Okay, again, I've chosen that because this is what the company itself has chosen to compare itself, right? In the promotional material, I think they had double the Sharpe ratio, as we saw earlier, and these are the actual returns, and they're much worse. Okay? The AQR fund fell by 8%, those guys fell by almost double, 16, almost 60%. Okay? These are data kind of this Tuesday. Okay? I've also included a comparison with S&P 500. This is not entirely fair. Okay, we should better compare with a balanced 60-40 kind of portfolio. But just to give you an idea, since late January or February, when the fund was first active, the S&P is only down, as of Tuesday at least, 3.5%. Again, the fund is down 15.6%. Okay, so first lesson here: be wary of backtested results. Okay, be wary of data mining. Those guys may have chosen the parameters of the model in order to maximize the return in backtested data. Okay, so when you data mine your modeling approach, okay, you will get something that works in sample, but obviously doesn't work out of sample, or at least hasn't worked till now. Okay, so does this mean that robo-advisors are useless? No, absolutely not. Okay, robo-advisors can outperform humans in matching consumers to mass market financial products. As we said, the issue is that they're not immune from the misalignment of incentives that has historically affected intermediaries. Okay, You can design a robo-advisor to ignore those incentives, but then the intermediaries that develop or purchase robo-advisors are subject to those misaligned incentives. Okay? So there's a kind of a double. We have to see it both from the point of view of the regulators. So financial regulators need to understand enough about computer and data science in order to apply these new regulated strategies and to link it with what we are saying earlier. The computers and data scientists themselves, who are at the forefront of this innovation, will need to understand enough about ethics and adopt a professional ethos and code of practice. Okay? Thank you very much.
Last but not least. My colleague Chad is senior consultant at NLPFM. Should I read you about it? Yes, I shall. Chad graduated with an economics degree in 1999 and started his financial planning career in 2000. He's previously advised clients at TDO's Story Page, Wealth Management and Mercer, and originally joined NLPFM in 2005. Chad works closely with professional connections and develops relationships with their individual and corporate clients. Whilst he has particular strength in tax and investment planning, he's passionate about understanding what's truly important to a client in creating an individual financial plan to help them achieve their objectives. He works closely with all of his clients and meets them frequently to review their plans and advice as required. He sits on our investment committee of NLPFM, and having experienced stock market downturns in 2000 and again in 2008. Chad attaches particular importance to ensuring clients fully understand their portfolios and long-term planning. Away from work, he enjoys spending time with his young family and friends. He's recently joined the coaching team, his son's football team, and enjoys all sports, in particular cricket and football. Chad, over to you.
Thank you, Chad.
Yep, can you hear me? Hi everyone. As Jacob said, I'm a financial planner. For those of you who are not familiar with financial planners, in a nutshell, we give clients advice on a range of financial planning matters. For example, if a client can see us to plan for their retirement, we can put in place a suitable strategy for them in terms of product and investment, and we can review that on a regular basis. Now, I've been in the financial planning industry for 18 years, and over that period of time, I've experienced a lot of change in terms of technology in the wealth management space. In most cases, that technology has been very helpful. It's added value, allowing me to do my job more comprehensively, more precisely, more efficiently. But there is a challenge as well. Technology has given rise to a different type of financial planner, automated financial planner, similar to the robo-advisor that was mentioned in the last presentation, and also some direct self-invest consumer platforms that are available online. In today's presentation, what I'm going to look at is a couple of areas. I'm going to, first of all, just tell you a little bit about the firm that I work for. I'm going to tell you what a financial planner does, and then I'm going to focus on the impact of technology has been on my industry, the financial planning industry, and how we're competing with technology-based offerings such as robo-advisors. And finally, I'm just going to look at where we could go to next, technology changing all the time. Now, a little bit about the firm I work for, NLP Financial Management Limited. And the first thing I'm going to say are the views in today's presentation are my own, and not those of the firm. NLP Financial Management Limited, we opened in 2003. We look after over £700 billion of group assets under management. We're London-based, just up the road from Main Street, and we are a profitable, successful firm. From a technology point of view, it's been brilliant for NLP financial management. 15 years ago, so when we opened the firm, there's no way a consultant like me could have looked after the amount of clients I looked after and the assets I looked after, because the technology simply wasn't there to support it compared to what we can do today. So if I give you an example, if a client phoned me in 2003 and asked me for a valuation for his portfolio, I would prepare that. It would take me probably 2 to 3 hours to prepare, because I've got other work to do. I would get round to it for 2 or 3 days. And eventually the client would get in the post a valuation. Now if a client phones me today and asks for a valuation, I can log on to an app on my phone, and within 30 seconds I can give them a valuation of their portfolio. Within 5 minutes, due to technology moving forward, I can tell the client what holdings they've got in their portfolio, what gains they've got, what gains they could capital gains tax they could pay, say if they wanted to sell part of their portfolio, their entire portfolio. I can tell them how the portfolio is invested in terms of asset class, geographically, by market size. I can even tell them what the exposure to, say, a stock like Apple is, all within 5 minutes of using my phone. So technology has really helped us as financial planners. It's allowed us to deliver a more efficient service to our clients, but more importantly, it's enabled us to actually plan for our clients. We're no longer bogged down in administration, alike we are to some extent, but we can focus on clients' needs rather than doing administration and office operations. The other point to mention about NLP financial management are that we are a unique financial planning business. We're unique because we offer financial planning to our clients, and we have in-house investment solutions. Now, our investment team has benefited from technology. Again, 15 years ago, they would have needed to go to a lot of different areas to obtain information on funds in terms of quantitative and quantitative data they need, so we can research a fund or an investment. Today, I'd say within an hour, we can vet a whole sector, say 2,000 funds, and narrow them down to 10 or 15 that we'd like to use in our portfolios, because we've got good technological tools in the office. So, technology for NLP financial management has been a big plus. In terms of what I do, I'm a financial planner. Now, in simple terms, I advise clients on financial planning matters. And broadly speaking, there's 5 areas. I advise clients on savings and investment, retirement, protection such as life insurance, estate planning, and I also do some tax planning. A lot of the work I get is from accountants, so I'm quite familiar with tax, whilst I'm not authorised to give that advice. Naturally, I've learned a little bit about tax and the value that we can add. Now, traditionally, I would say financial planners didn't exist 15 years ago. So because we just didn't have the tools, maybe not the regulation, the industry was a bit more immature. But now, today, they do exist. And in terms of our competition, our online competition, say robo-advisors, they can probably do savings and investment for clients, they can probably do retirement, possibly even protection. Yeah. But where financial planners can distinguish themselves is that we focus on outcomes. When I sit down with clients and they can see, say about their retirement, we're interested in knowing not only the hard facts when they're looking to retire, what they can afford to contribute, etc. We want to know, what are the assets they've got, which may help fund their retirement, etc. And we'll put it all together to formulate a financial plan. We'll go on a journey with our clients, so we see our clients on a regular basis. Every 6 or 12 months, we sit down with clients, we'll review the plan, we'll review the investments, and in that way, a financial planner is not transactional. Yep. We're in it for a long-term journey, whereas historically, a financial advisor may have just set up a plan and never reviewed it. Now, the UK advice market, or financial planning market, has changed. I would say 15 years ago, there were 2 segments. There was a financial advisor who would be transactional, and they'd probably advise clients to a certain level, say 750,000 or £1 million. And then after that, clients would go to private banks. Now, this is quite a simple diagram. There's a lot more players in the market 15 years ago, such as family offices, etc. But broadly speaking, there were two levels of advice in the UK advice market. Now, what's happened today is, I would say, there's three segments. We've still got financial advisors working high street banks that are offering simplified advice. It's transactional in my view. You know, they set something up, they're not really involved in the long-term servicing of that. We've seen the rise of self-investment platforms online and robo-advisors. After that, we've got financial planning firms. Now, financial planning firms have developed for various reasons, but amongst that is technology. Technology has brought into the marketplace self-invest platforms, robo-advisors, and if we, which once upon a time we were financial advisors, still want to exist, we've got to offer a bit more, and that's financial planning. We've got to focus on outcomes, we've got to service our clients, we've got to do something more than what a computer can do to ensure that we can both survive and continue to be successful in this environment. Just going back to this, in terms of where clients are serviced, or what size, I would say typically clients with less than 100,000 or so to invest would be in this box here. When clients have got more than that, I mean, as a firm we generally look at 250,000 as a minimum, they need to see a financial plan. Yep. They have more of a complex requirement, and we can add value. And the private banks still exist, they tend to be more high net worth clients, say in excess of 2 million, 3, 4 million pounds to invest. Now, there could be a question to say, well, if a client's got $500,000 to invest, why would they necessarily need a financial plan? Robo-advisors are more cost effective. There's no initial charge, the ongoing charges are lower, and to some extent I agree with that. I think for certain clients, robo-advisors for us are not a threat. They can complement the market. There's some people that need help, that won't get access to financial planning firms. For that reason, that segment still has a job to do in the UK wealth market. Now, in terms of the value a financial planner can add, I put together a case study. The situation here is a typical sort of client that we would deal with. We've got Michael and Elaine, they're married, they're both 50 years of age, directors of their own company. They've got taxable profits in their company of £400,000. They draw dividends of £50,000 each per annum. They've got cash in their business of £1 million, a further £500,000 to help personally. 2 children at school hoping to go to university, a house with a value of £1 million, a mortgage of £250,000, and they've got some existing pensions. Now, what Michael and Elaine want to do is they want to invest this £500,000 they've got personally into a portfolio to achieve better returns, because sitting in the bank is not earning much of a return. They could go online, use a robo-advisor, and through the robo-advisor's algorithms, etc., may conclude that they should invest £400,000 into an investment account of index tracking funds, and the funds will be managed going forward, which is perfectly fine from the robo-advisor point of view. As a financial planner, however, the value that we add is through probably a couple of meetings with them at the outset. We would identify what we think are their objectives. We'll understand their situation, think about potential outcomes, and in this sort of scenario, the way a financial planner could add value relative to, say, an automated approach through a robo-advisor is through, we could do some tax planning. They're drawing dividends of £50,000 each from their portfolio. Income above £45,000 in the UK is taxed at a higher rate, and given that they're sitting on £500,000 in the personally, do they need to take that much income? So straight away I would say to that sort of client, maybe you should limit your income to £45,000 or pay less tax. As well as that, they're not taking a basic salary. So in the UK, you can take salary through pay as you earn, paying the tax and national insurance on it, as well as dividends. And they should take a basic salary because they accrue a year's state pension. So we would add that money to them. The other objective we'd identify is that there's a risk here. They both run a business, a successful business, but if something was to happen to them, accident, illness, premature death, their business would be affected and so would their finances. So as a financial planner, we may suggest having some protection in place to protect their position. Carrying on from that, we can look at investment planning. So they came to see me or robo-advisor to invest £500,000. And what I would probably suggest to them is they look to pay their mortgage off. It's £250,000. Now, when you're investing, it's impossible to quote what future returns are going to be. But in a balanced multi-asset portfolio, typically say 4 to 7% per annum is acceptable. On the mortgage, say if they're paying 4% interest, it could be to take that risk-free would probably be the best advice that financial planning can give them, or at least give them that option. Had they gone to self-invest, they probably wouldn't realise to do that. Carrying on from there, we can give them advice on retirement planning, ensure we can get the company to make contributions and make a significant corporation tax saving. We can also give them advice on estate planning. Currently, their assets mean that they would be an inheritance tax charge on their estate in the event of premature death. There's loads of other value points that we could add. I haven't got time to go through them today. I guess the key message I'm giving is that there is a space for a robo-advisor, but in a lot of cases, financial planners can still add a lot more value than, say, a technology-based solution. Now, financial planning, in my view, is quite a recent phenomenon. It's come into the system for 10 years. As financial advisors, once upon a time, we used to all talk about financial planning and how we were financial planners. But I don't genuinely believe that existed back in 2003 when NLP financial management first started off trading. And the reason why financial planning has come about is due to compliance. Our regulator has become a lot tougher and it's good. There's a good framework in place to make sure that our clients are looked after properly. It's also due to high levels of professionalism and qualifications. Our industry is becoming more mature. There's been a bit of a change in the guard, meaning that we are more widely qualified in terms of being in a place to offer better advice for our clients. Consumers are more savvy. Yeah? With the rise of robo and online offering, when we see clients, they know that they can go elsewhere and pay a lot less for a similar sort of service. So they want to see what value we're going to give them as financial planners. Business models have changed, meaning that as a firm, we're more valuable if we have clients who have got assets invested with us. So we need to service those clients to ensure that the clients stay with us. But the big change, in my opinion, has been technology. Technology has allowed financial planning to evolve because we've got better back office systems. As I mentioned earlier, we can do evaluations immediately. We can look at clients' portfolios in more detail, quickly. Investment capabilities have moved on through technology, allowing us to manage quite successful portfolios. We run a number of portfolios at NLP Financial Management, track record since 2008, and part of that success is due to the technology that our investment team have been able to use. The other big change from a technology point of view is platforms. Platforms have been around for about 20 years, but over the last 5 or 6 years have become more mature. And what they do is they allow us to host a client's portfolio and invest into a range of investments via the investment houses. So for example, we could have on one platform investments in a range of fund houses, from Jupiter, Schroeder, M&G, we can hold them all in one place. So the platforms have really helped us from a technology point of view. Cash flow planning is a tool that we use, which again is fairly new in the financial planning industry, but it allows us to sit down with our clients and predict based on a range of variables and assumptions where the outcome of the strategy. So if they were saving a regular amount or a lump sum, we can look at potentially what that lump sum could be valued at in, say, 20 years' time, factor in variables such as inflation and tax, and that really helps our clients sort of formulate a strategy, helps us formulate a strategy. So that's technology which has been very positive. Online competition has actually helped, I believe, financial planning. It's meant that we've upped our game because we've got to compete, we've got to offer something different, and rather than being a negative for the financial planning industry, it's a positive. Now, when we're comparing ourselves to online offerings, which are, I would say, beginning to have a bit more of a presence in the UK wealth management market, and will do going forward, we have to look at what clients value. We know that clients do value low cost. Ideally, everybody in this room, if we could pay less for something that we use regularly, would do that. So, a robo-advisor, for example, is a lower cost offering than a financial planner. So clients do value lower cost, we're aware of that. Clients, or today's client, values technology. They like to be able to log into something with a nice portal. They like real-time valuations. They like to make changes instantly. And again, a lot of online offerings probably are better than a traditional financial planner in that space. Or what a financial planner can offer, which perhaps a technology-based offering can't at this moment in time, is access to qualified professionals. It's a professional who can take a broader view of assets, aspirations and preferences. Again, we go back to the recent case study I presented, and you can see on that case study we identified objectives that perhaps a client doesn't identify. The clients really value that. Clients value a wider range of solutions. At the moment, our online competitor, a robo-advisor, will typically only offer 3 or 4 products: a pension, an ISA, a general investment account, and they offer quite a limited investment strategy, passive index tracking based one. Whereas if a client was to see us, we can offer them a range of products and a range of investment strategies, and they do value that. Clients want active management. Again, online-based offerings are quite passive, quite long, whereas NLP financial management, we will make changes to portfolios if we believe that is relevant. Clients value a track record. We've got a track record since 2008. It goes back in some cases longer than that. But when we're talking about robo-advisors, because they're fairly new in the UK market, they've got an 18-month or a 2-year track record. They haven't really invested money in a top market, except, try to see what things are like in October. So clients, when they can see, is they do like the fact that we've got a long-term track record. It does have value. Back testing sometimes does not work. And finally, clients want help in tough markets. Over the course of October, I rang a number of my clients to talk to them about their portfolios, to explain a little bit about what's happening from a volatility perspective, etc. Our investment team have put together notes which we shared, trying to reassure clients. Whereas when clients are self-investing or they're using robo-advisors, and suddenly they see that their account has dropped from 50,000 to 40,000, they panic. Generally, people sell. Now, I do some self-investing on a platform online. And one of the interesting things I saw this week was there was a note from the provider, and the footnote said that a recent survey suggested that there were a lot of people using their self-invest platform who didn't expect investments to fall in value. Which suggests that consumers who are using some of these platforms are unaware that investments can fall, and it's simply not the right place for them to be invested. So, helping clients in top markets, educating them, means it's a real added value from a consumer's point of view. So, yes, when we look at the challenge of robo-advisors, as planners, we do face the challenge with low cost and technology, but we offer a lot more, which will hopefully mean that we can continue as financial planners for many years ahead. Now, where next with technology? We talk to our clients all the time, and the feedback that we're getting from looking at press, etc., is that we will probably need to do something in terms of our data and our communications. We're already encrypting information, we're already very safe with our client data, but clients are becoming more and more keen about how their data is kept, and as a consequence, we might start having to look at portals, secure portals, when communicating with them. So why the challenges there are. Open banking is a fairly new concept. It's where banks share information with third parties in terms of their clients' balances and spending patterns, and as advisors we need to look at that to see if it adds value when we're dealing with our clients. Because clients want us to know what their expenditure is, what their income is, and they want to incorporate it into their financial plan. Not every client wants us to do this, and we're not sure how much value it's going to add. But we've got to offer that going forward, because if technology moves in that direction, we need to be pace. Clients are looking potentially for aggregation of wealth. So they don't want to just log into an app and see how much their NLPFM portfolio is worth. Ideally, they want to log into an app and see what their house is worth, what potentially their bank accounts are worth, what perhaps some of their personal investments outside of NLPFM are worth, and what our portfolio is worth. So a one-stop shop for all of their finances. And again, we're looking at tools for aggregation of wealth and also tools which would add other financial planning and investment opportunity. The platforms which we are using are changing as well. They're modernising, they're adding more tools, again, to bring their interface and usability up to current times. From a technology point of view, we are aware of robo-advisors. We're aware that they're a lot cheaper than us. And it may be that in time we have to lower our cost or offer a lower cost service in order to continue trading successfully. So I would imagine we would look at lower cost options in time. We are aware of the emergence of blockchain and cryptocurrency. Our investment team are aware. It's too early for us to get clients' assets invested in that sort of investment because they're fairly young investments and we focus on both growth and preservation. And there will be, no doubt, emergence of other ideas and functions. So, in terms of technology, where it's going to take us to next, I'm pretty sure there's been a lot of change in the last 20 years, and I'm sure going forward there'll be a lot of change as well.
Chad, thank you very much.